Welcome to the Tech Today podcast. It's your host, John Mayetta. CPI has proved to be stubborn, as we've been talking about for a couple of years. It's going to be especially stubborn, whether we're talking about headline CPI or core CPI. It's going to be especially stubborn between that 3 to 4% range. I don't think the Fed's going to get CPI down to 2%. I've never believed that. The reason is because the United States has so much debt outstanding, north of 34 trillion, that the Fed can't afford to keep its Fed funds rate elevated for an extended period of time. It will drive the interest service expense through the roof, right? We're going to be at about $1 trillion of interest expense in fiscal 2024. And that's like north of 20% of tax receipts, federal tax receipts. So we simply can't afford these elevated interest rates. And I wrote that all the way back in 2021 in our book that is entitled Stagflation is Imminent, which is available on Amazon as a Kindle book. With debt, treasury debt exceedingly high, the Fed simply can't afford to keep rates high for an extended period of time, period, regardless of what's going on with inflation. And so I believe that the CPI between 3 and 4% is going to be especially stubborn. With core CPI at 3.9%, it's right in line with the 10-year Treasury yield. So that tells you we have a real interest rate of 0, which means that the Fed isn't nearly as hawkish as it's sort of portrayed itself to be over the past couple of years. You know, a hawkish Fed would have real interest rates well into positive territory. But given that the Fed has had its Fed funds rate right around neutral for a period of time, and given the Fed's sort of modest QT program, I've never considered this Fed under Powell to be a hawkish Fed. Not even when it was fairly quickly ramping up its Fed funds rate, given that rates were so negative. So where does the Fed go from here? Well, so there are a couple of things that are sort of conflicting. The economy is softening, which would suggest the Fed's going to lower. Prices are persistently high, which you would think would put upward pressure on rates. But as I said a minute ago, with Treasury debt so high, the Fed's simply going to have to live with a CPI that's north of 2%. There's no way the Fed's going to get CPI down to its 2% target. It's going to have to live with 3% and change at the core level, and maybe 3-ish at the headline level. And you're going to have muted GDP growth. And that's stagflation. That's why we wrote the book back in April of 2021. And that's kind of how I expect the rest of this decade to play out. You're going to have very muted GDP growth, elevated debt. Prices will be fairly elevated. Doesn't mean we have to have year-over-year CPI in double-digit territory, but prices spiked from 2020 through 2023, and they've been sort of flat-ish this year. So that's an elevated pricing environment because we haven't had deflation since the price spikes as a result of fiscal monetary policy in response to COVID. So when you have a high price economy, when you have a debt-ridden economy, and you have low growth, those three ingredients equal stagflation, and that's what we're living now. And I believe that's what we're gonna live for the balance of this decade. Now, in terms of the short term, you've got the labor environment softening a little bit. Labor participation, that number came in last week, so that's down. I think the labor environment continues to soften. I think the unemployment rate will continue to tick up. And so that all suggests sort of prices will come in a bit. Meanwhile, we have a Fed that's talking about lowering rates. So that certainly doesn't put downward pressure on prices. And we have a Fed where one of the officers was out last night saying they're going to allow the BTFP to expire on March 11th. So that means all the underlying bank collateral is no longer going to have that crutch. And the big four banks, of course, will report later this week on Friday morning. Bank of America, JP Morgan, Citi, and Wells Fargo. And we'll see what the net unrealized losses look like. So in terms of bank collateral, which is diminished, the collateral the bank uses to underwrite their loans is of diminished value because that collateral is purchased in years past when Fed funds was at or near zero. And of course, bond prices, collateral prices are inversely related with interest rates. Interest rates are now elevated, so prices on the collateral are down. What is going to sort of underwrite the value of that collateral? If you recall, the BTFP allowed banks to lend and to mark up the value of that collateral to par value. So if that BTFP goes away, what's going to support that collateral? The Fed's going to have to cut rates quicker than they're letting on. Is what will underwrite the value of that collateral and what will cause some of those massive unrealized bank losses to narrow. Right, I've talked before about Bank of America. They, as of 9/30, September 30th, they had 107 billion of unrealized losses in mortgage securities on their balance sheet, mortgages that were purchased at a yield of 2.12%. So if you're going to narrow that loss in a meaningful manner, that's only going to happen if interest rates get back near zero. So if the Fed's going to yank this BTFP crutch, it's got to replace it with something. And that would suggest lower rates and lower rates fairly quickly around March, which of course doesn't help CPI come in. That would provide support for an elevated CPI, which brings us back to stagflation. Weak economy, weak growth, elevated prices, and high public debt, i.e. Treasury debt. So we'll link to the book in the show notes as well. Stagflation's here to stay for a long time, unfortunately. That's all for now. See you next time.